Are you excited about tax season? Okay, probably not. But it does pay to take a little bit of interest in your tax return because thousands of dollars are available to low and moderate income families and individuals in the form of tax credits. Are you caring for a parent or pursuing an education? Do you have children under 16 or in daycare? If so, you could be eligible for a tax credit. Today, you'll learn how you could get even more back than you paid in, even if that number is zero, with the Earned Income Tax Credit. So stay with us and learn how to take back your taxes. Welcome back. Joining me now is Patrick Brown from the Internal Revenue Service. Patrick, we're going to talk today a lot about tax credits. What is a tax credit?
Well, a tax credit is a benefit on your tax return. If you qualify for a tax credit, that's going to reduce the amount of tax you owe and result probably in a refund for you.
So that's the benefit of tax credits?
Exactly. It's going to reduce the amount of taxes you have to pay.
Now, what's the difference between a tax credit and a tax deduction?
Well, let's start with a deduction. A deduction is something, it's an expense that you have that you subtract from your income. Now, when you take a deduction, you don't get the full benefit of the deduction because it comes off your income, it depends on your tax rate. For example, let's say you're at a 15% tax rate. So for each $100 deduction, you only get a benefit of $15, right? 15%. A credit, however, comes directly off your tax liability. So you get 100%. If you have a $100 tax credit, that's $100 less that you're going to owe, or $100 more you're going to get in a refund.
So if you owe zero and you get a tax credit of $100, you get $100?
Well, good question. It depends on the kind of credit. There are two kinds of credit. There's the non-refundable credit and the refundable credit. A non-refundable credit means that it reduces your tax liability to zero. So if your tax liability, let's say, is $50 and you got that $100 non-refundable credit, it would reduce your tax liability to zero and you'd lose the benefit of the rest of it. There are also what's called refundable credits. A refundable credit not only reduces your tax liability, but you get money back. So in that same example, if you had a $50 and a $100 refundable tax credit, you would reduce your tax to zero, and then you would get a $50 refund, refundable. Okay. That's why it's called refundable.
So refundable and non-refundable are going to come up as we go along, so you can point that out when we get there. A lot of credits depend on having a child or having a dependent. What's the difference between a child and a dependent? How do you qualify for those different designations?
Well, a lot of people think, well, in order to claim someone as a dependent, it has to be my child, right? But that's not necessarily true. When we get into the area of dependence, there's what we call qualifying children and qualifying relatives. To keep it simple, we're going to talk first about qualifying child. A qualifying child generally is going to be your child, but doesn't have to be. Could be your grandchild, could be your brother, your sister, niece, nephew even. The key, however, for a qualifying child is they have to be younger than you, and they have to live with you, and they have to meet certain age requirements, under 19, under 24, if a full-time student, or totally disabled any age. So that's the qualifying child. Now for a qualifying relative, the qualifying relative doesn't have to be a child. Could be your parent, could be your aunt, your uncle, a lot of different relatives. They don't have to live with you either, right? There's no age requirement. But what's important about a qualifying relative is you have to pay more than half of their support, and their income has to be below a certain amount. This year, $3,950.
Okay, well, since we're talking about children now, let's get started with the child tax credit. How much is that credit worth to a family?
Well, the child tax credit, if you have a qualifying child, cannot be qualifying relative, has to be the qualifying child that lives with you, is $1,000 for each child that's under 17 years of age at the end of the year.
Now, is this different than the deduction that you can take for your children on the normal form?
Yes, when you claim a dependent, you get a certain amount. For tax year 2014, you get to subtract $3,950 from your income. right?
Ah.
It's similar to a deduction, not a credit. The child tax credit, however, is a credit, so that $1,000 for each child under 17 comes directly off your tax liability. And it can be refundable also. So depending on your income level, you may be able to get part of it, even though when you reduce your tax to zero, you can get the $1,000 or part of the $1,000 as a refundable credit.
So that is a great thing.
Yes.
Now, does this have to be a biological child? Could it be a grandchild, an adopted child?
It can be an adopted child, a foster child, a grandchild, as I mentioned before, brother, sister, niece, nephew. There's a whole list. If you go to irs.gov and do a search for dependents, it'll give you all the information.
Now, is this one of the instances where the child has to live with you full-time?
For a qualifying child, they have to live with you more than half the year. So in cases where there's perhaps divorced or separated parents, it's important to keep track of how many nights the child spent with each parent to determine who qualifies to claim them as a qualifying child.
Oh my gosh, that sounds like a workout. So there's also, this is very confusing, the additional child tax credit. Can you tell me how that works?
Well, the additional child tax credit, if because of your income, you have your tax liability is zero, so you don't get the benefit of the regular child tax credit, then depending again on your income, there's a calculation you do. It's a little complicated to explain, so I'm not going to bore you with that. But then that becomes refundable, and you get that money as a refund.
Okay. Is there a limit on your income to qualify for that credit?
Well, yes, there is. It's about, for a married filing joint, it's a little over $100,000, and then it phases out. The way, though, that the additional is calculated is based on your earned income. And again, like I say, it's pretty complicated to explain in a short period of time.
But
nobody wants to hear it.
The short answer is yes, but look into it.
Yes.
Okay.
Yeah.
Now let's talk about the child and dependent care credit, since we've been talking about dependents too. This credit can be worth thousands of dollars to families. How do you qualify for it?
Well, the child and dependent care credit is, like it says, is for your children and for certain dependents where you can pay for child care and you get a credit on your tax return. Now, the way that works is that, first of all, it has to be, if it's a child, it has to be a qualifying child. It has to be a child under 13 years of age. If it's another dependent or your spouse, it can be a spouse or another dependent, but it has to be someone who either physically or mentally cannot care for themselves. Right? Now, how that works, it's a non-refundable credit, so you don't get money back if you owe no taxes, and you get a percentage of the expenses that you pay so that you can go to work. That's what the purpose is so people can have somebody take care of their kids while they go to work.
Outside of the home. Mm-hmm. Okay, so can you tell me what the maximum care expenses are on this?
Well, if you have one child, the maximum expense is $3,000. If you have two or more children, the maximum is $6,000. But remember, it's a percentage. It's a maximum, I believe, of 35% of the amount you spend up to the $6,000. And that varies with income. All right, the higher your income, the lower the percentage.
So I want to ask you one more thing about this. There are limits on who can be providing the care. Can you give us an example of someone who could not be providing the care for this?
Okay, well, you cannot be paying someone who's your dependent. You cannot be paying someone who is your child under the age of 19. Those are the only two off the top of my head that I can think of that are exceptions.
So it just can't be someone who's in your family who you're already claiming as a dependent?
No, it cannot be.
Okay,
It has to be generally an outside person. It can be related to you, Could be your parent. That's very common, in fact, that somebody pays their parent to take care of the grandchild.
Sure, and that would be a nice, safe choice. So let's move on to the earned income credit.
Okay.
I love that one. It's one of the most beneficial to the most people, but a lot of people don't take it. Can you tell us why they don't?
Well, the earned income credit is a credit for, originally it was for families. Back a few years ago, it was expanded so that it's also for people without children. And I think a lot of the people we see that don't claim it are people without children because they don't know about it. And they think, oh, I didn't make enough that I have to file a tax return, so why am I going to pay somebody to file a tax return? So they just don't file. But people without children, a single person up to about $14,000, married people up to about $20,000 can qualify for the earned income credit even though they don't have children.
Yes, and that's really important. I know a lot of self-employed people don't do it because they don't think that they qualify.
Right, that is correct.
Now, I love this, this is my favorite number in all of this research, is what is the maximum a family could get from this credit?
Well, again, the maximum that you can get is a little bit over $6,100 this year. That would be for a married couple with 3 or more qualifying children. And remember, we talked before about what a qualifying child is, has to live with you, etc. Again, not everybody who files is going to get the $6,100 because if you have 2 or more qualifying children, the maximum is less. And again, depending on your income level, that's how it's determined.
Okay, all right, that sounds fair. Right. If someone had an investment, would the income from that investment disqualify them for this credit?
There is a limitation on investment income. For example, if you sold stock or if you have a lot of interest or dividends, things like that, that's what we call investment income. For this year, I believe it's $3,350. If you may have more than that in investment income, that disqualifies you. Also, if you don't have children, there's also an age limitation between the ages of 25 and 64. So people 24 and under and 65 and over don't qualify for the earned income credit unless they have qualifying children, including grandchildren. So if you're taking care of your grandchild because the parents are not in the picture, you may qualify for the earned income credit, assuming you have earned income, right? It has to be wages, self-employment, etc. And not just pension. Pensions are not considered earned income.
Earned income. Okay, all right, thank you. That's a good point. I want to talk to you now about people pursuing an education. And the first one I want to talk about is the American Opportunity Tax Credit. And now this one, it helps working students pay for their education. Is it better than a tuition deduction?
Well, you're talking about the tuition and fees deduction, I'm assuming. Again, when we spoke before, we talked about the difference between a deduction and a credit. Generally, for low to moderate income taxpayers, a credit is going to be much more beneficial than a deduction. So there are 2 ways that actually 3 ways that you can take education expenses. You could take the tuition and fees deduction, but remember, it's a deduction, so you only get a percentage based on your tax rate, right? So for low income, like we spoke before, 15%, you don't get a lot of benefit from the deduction. The American Opportunity Credit is generally the one people go for first because it's a maximum of $2,500 in credit. It's good for the first 4 years of post-secondary education. So as long as you don't have a bachelor's degrees already, you can qualify for it. Again, it's only good for 4 years, so you can't be an undergraduate for 10 years and take it. You only get it for the first 4 years. It's partially refundable, up to 40% of it. So if you got the maximum $4,000, up to $1,000 could be the maximum is $2,500. So the 40% of that would be $1,000 is refundable. So it's actually a very good credit.
So you could get a check back if things played out right.
Yes, you could.
Okay. Can you claim this credit if you are sending a child to college? If it's not you, you're sending to college, but someone else?
Yeah, you qualify for the American Opportunity Credit and actually all the tuition and fees deduction, the lifetime learning credit, which is another education credit, and the American Opportunity Credit for yourself, your spouse, and anyone you can claim as a dependent.
Cool. That's really nice.
Yes.
I want to talk to you about the lifetime learning credit.
Okay.
Since you brought it up, how does it differ from the American Opportunity Credit?
Well, the American Opportunity Credit, as I mentioned, is for the first 4 years of post-secondary education. You have to be at least a half-time student, okay, so you can't just be taking one class. The lifetime learning credit, you can just take one class. American Opportunity Credit, you have to be a degree candidate. You have to be going for a degree. Lifetime learning credit, as long as it's something to acquire or improve job skills, which is practically anything, right? You can qualify for the lifetime learning credit. Now, it is only tuition and fees, right? And it's based on, it's a 20% of your tuition and fees. And it's a maximum of $2,000. So up to $10,000 in expenses, 20% of that would be $2,000 maximum.
And what counts as fees?
Well, fees are like required fees at a university. When you register, there are certain things that are required. Notable exception, however, is if you have to take medical insurance at the campus, that is not considered. That would be a medical deduction, not a required university fee.
Okay, I hadn't thought of that. I figured I was going to say that next. So it's a medical card and a parking permit and all of those things, but not the medical.
Not the medical.
But books, required books?
Books are only for the American Opportunity Credit.
Okay.
All right. Sometimes for lifetime learning, you can deduct books, but it's very, very rare. Okay, they have to be required to be purchased through the university for the class, which is very, very rare.
So how do you qualify for this credit? It sounds very exciting for lifetime learners.
Well, like all credits, there are going to be certain income limitations. Generally, for low to moderate income taxpayers, not a problem. You usually get into limitations when you start making over $100,000. I think for the American Opportunity Credit for joint, I believe it's $160,000 for a couple. So it's rather high to where it starts to phase out. But you just have to have those, like we spoke about, you have to be a student at a university, and it has to be you, your spouse, or your dependent.
Pretty easy. So can you claim both? Can you do the American Opportunity and the lifetime learner?
You cannot claim both credits or the tuition and fees deduction for the same student during the same tax year. But let's say you had two children in college. You could claim American Opportunity Credit for both, or you claim the American Opportunity Credit for one, and the tuition and fees for another, and the lifetime learning for another, or any combination, as long as you don't claim credits for the same student in the same year.
So it can't be redundant.
Right.
So if you really were a lifetime learner and you wanted to go and get a bachelor's and then a master's, could you use, if you were on your own and not being supported by your parents, the American Opportunity Credit for 4 years and then take the lifetime learner credit?
Well, as it says, it's a lifetime learning credit. So if you're 85 years old and you want to go and you want to take a computer class, right, you can do that.
Okay. Now let's talk about the Savers Credit. Can you tell me a little bit about that? What's the purpose of the Savers Credit, or what's the benefit?
Well, the Savers Credit is a credit that was passed by Congress to encourage people to save for retirement. And it is a credit that is a non-refundable credit, so you don't, again, get it back. It just reduces your tax to zero. And if you make contributions to a pension plan, for example, a 401k where you work, that qualifies. If you contribute to an IRA, an individual retirement arrangement through a bank, that also qualifies. What you do is you take a percentage of your contribution, and that becomes a credit. Now, this is mainly aimed at low to moderate income taxpayers. For high income taxpayers, they don't get it. And again, the percentages vary based on what your filing status is, whether you're single, married, head of household, what your income level is also. The variation in percentages you get between 10% and 50%, again, depending on your income.
Wow, so you could actually save a lot of money without actually putting a lot of money into an investment.
Yes, that would, if you know how to do it, you can actually, you can get good benefit. For example, an IRA, if you're low income, you can also deduct the contribution of the IRA, and then you can also take a credit for that same money.
It's almost free money.
It can be. It can be. You can get quite a bit, actually.
So who is eligible to qualify for a saver's credit?
Pretty much anybody except students. You can't be under 24, believe in a full-time student and qualify. So it's for people who are now working, right? It's not for students.
Okay. So I have one last question for you. Is it? I think that you see in the news a lot of information gets stolen right out of the air when people put things on the internet. What are the safeguards, and is it safe to file your income tax return electronically?
Electronically, yes.
Because you're putting your Social Security number out there.
Well, the IRS has never had a case where the IRS systems have been hacked with electronic filing. It is a very, very secure system. It's very safe. And, a lot of the things I talked about, it's sort of hard to explain exactly how you do it. Of course, the IRS has forms where you can fill it out line by line. But if you do e-file, if you go onto the irs.gov, the website, and you click on free file for people who make under $60,000 a year, you can qualify for free preparation of your income tax return. It'll calculate all these things for you. You don't have to know all the rules. And you transmit the return, you get your refund within a couple weeks. It's safe, secure, do direct deposit, so nobody's going to steal your paper check. And like I say, millions and millions of people do it. We have now, over 80% of taxpayers are now filing electronically.
Now, if you do it electronically, does the electronic form alert you to credits that you should be taking, that you qualify for?
When you go onto irs.gov and you select one of the free file vendors, the free file vendors are approved by the IRS to be on a link from irs.gov, and there you go through and you answer questions. They ask you questions about your circumstances, and you answer the questions, and it guides you right through to all of the benefits.
So it's really better than doing it yourself on paper.
On paper, definitely, yes. On paper, a lot of people make mistakes. On paper returns that the IRS receives, there's approximately a 20% error rate. On e-file, it's less than 0.5%.
Wow. Well, Patrick Brown, thank you so much for traveling all this way to share this information with us. I'm sure everybody got some tips they can use to help them this tax season. We'll be right back with more information on where you can get free help to prepare your taxes. Welcome back. Joining me now is Roxanne Moore with some information about how you can get free help to prepare your tax return through VITA. Roxanne, what is VITA, V-I-T-A?
It's the Volunteer Income Tax Assistance Program. So it's a national program from the IRS that partners with local nonprofit organizations to provide free tax services in your community.
Now, there are other organizations that do it. What's the advantage of choosing a VITA center?
Well, that's there, and there are other free options. For example, people can go to myfreetaxes.com and use a self-guided software to file their taxes. But the advantage for a lot of people, the advantage to coming into a VITA site is that because you're working with a local nonprofit, they know their community, they know the community's needs and the resources available, so they can connect you to other resources. Like, for example, during tax season, we have a lot of people find out that they've been a victim of identity theft or other problems, or they might need financial literacy, financial workshops, or might have other needs that could contribute to the financial stability of the family, and you could be connected with some of those resources.
Oh, so there's more to get than just your taxes.
Yeah.
You have a lot of financial help available.
Yeah.
Now, who can get this information and service free?
Okay, so anyone who, any individual who earns less than $53,000 a year, if you're disabled, elderly, or limited English speaking, qualifies for VITA services.
Okay. Now, the people that actually do the work are volunteers, and we know there's kind of a high margin for error when people file tax returns. How are the volunteers trained? Why are they better than trying to do it yourself?
Well, all of our volunteers are trained and certified by the IRS. So there's an online training program, it's called Link and Learn, that they go through, and they'll earn different kinds of certifications for different kinds of tax issues. Like, for example, if the taxpayer is in the military, or if they have a health savings account, or things like that. So they're certified not just for basic taxes, but also for some more specialty concerns as well. And then as far as margin of error, we use software from the IRS that helps kind of filter out some of those common mistakes to make sure that your return isn't going to be rejected.
Now, one of the mistakes people make is with the earned income tax credit. A lot of people assume they don't qualify, and so they don't file. If someone now realizes after watching the program that they do qualify, can they come in and do a return from last year or the year before?
They would have to contact their local VITA site to find out if they can get their back taxes done there. I would say to go to your local VITA site, get your taxes done for this year, and then start working on your previous years.
Now, how do you find someone to help you? What do you do? You're at home and you want to take advantage of VITA. How do you find?
Well, anyone can pick up the phone and call 211, which is a national hotline. It's free. It reaches 90% of America, and you can just ask them, how can I get my taxes done? It's a hotline that helps with all kinds of health and human services issues.
Okay. Thank you, Roxanne Moore, for coming here today and sharing this great information. I'd also like to thank Patrick Brown of the Internal Revenue Service for traveling here today to share some ways that you can take back your taxes. Even if you only file for the earned income credit, it'll make a big difference to you, your family, and the whole community. When you spend some of those extra dollars in town, you support the local economy and help to preserve and create jobs. The number to call to find free help preparing your taxes is 800-906-9887. Thanks for watching.